right, thank you. Well, I'm delighted that we have this evening put together. I'm the chairman of the Sloan Club, and this is a joint event between the MIT Enterprise Forum and the Sloan Club. We actually did this type of event starting in the mid-90s, and it sort of stopped at some point after the tech wreck. And we felt that given the interest and excitement of technology today, that it would be timely to restart it. And so the idea is to give you a breadth of views and angles about technology from different people in different stages of technology investing. But anyway, we're delighted to have it. Thank you all for coming. And I'd like to introduce Mark Schneider, who is the moderator. Mark is an early stage investment professional active in the funding high growth potential companies. In addition to being an active angel investor, he aids companies in developing business models and strategy. He serves on a number of boards, including New York Angels, Angel Investor Forum, Inroad, a SaaS-based hotel management systems company, and Brain Century, a company dedicated to reducing head injuries in impact sports. Early in his career, he was founder, CEO, and chairman of a group of software companies which provided software systems and transaction services to the pharmaceutical fulfillment industry. Mark holds a BS in mechanical engineering from Tufts, a master's degree in engineering from MIT, and a master's degree from the Sloan School at MIT. Thank you.
Thanks, Steve. Okay, so the way we're going to do this, we're sitting in more or less order of the size of the business as we tend to operate. So at this end of the table, we invest in the earliest stage companies, and they get larger in that direction. So the way we're going to do this, I'm going to introduce each person. In fact, given the time, I think I'm going to skip the reading of the bios and let each person tell about themselves anyway, rather than be redundant, so that we can get to a list of questions that some people have provided, and then we'll leave plenty of time for questions after that from the audience. So each of us take about 3 or 4 minutes. Promise, everybody? I can't resist because Dave and I know each other for a while investing. In fact, we met at a post-mortem for a common investment. So not everything we invest in is a 10 or 20x return. They're prospect, but nevertheless. So anyway, Dave, why don't you tell everybody who you are, and then we'll pass the baton over in time.
My name is David S. Rose. I'm holding down the seed end of the world here, investing in really, really early stage startup companies. I'm an angel investor, have been one for probably 15 years at this point. A very active angel investor, so I've invested in probably 95 companies in my portfolio, which probably puts me in the upper end of the angel world. I think I have the unique distinction of being the only third generation angel investor I've ever heard of, since I come from the line of angels. And since I like to run around in groups, I helped to found New York Angels, which is the most active angel investment group in America at this point. I think now probably for the 2nd year in a row, although the stats haven't officially been announced yet. New York Angels, of which Mark is also a member, invests in early stage companies, mostly technology based, which we'll be talking about today, and has done over 100 companies since we've been around. As an entrepreneur, I'm also a serial entrepreneur, and I started a company myself called GUST, G-U-S-T, which serves as the online technical infrastructure for much of the really early stage financing industry. So it's the online internet platform that's used by New York Angels and most other angel groups in the world to manage all of their applications, their portfolios, their collaboration among members and the like. And so on the other side, it's used by nearly 250,000 startup companies to manage their investor relations. So between 250,000 startup companies and 50,000 accredited investors and 1,000 angel groups and venture funds, it provides the sort of common infrastructure for this really early stage world.
Is this on? Is this on?
We have 2 mics, so we have.
Yeah, is this one on?
No, it isn't. So I guess we have 1 mic.
All right, I guess we have. The battery life is it's close.
No, I think you have to hold it very close.
Very close. Like put it in my nostril. Okay.
We'll play with this
now
one.
that we're straight on that. So I'm John Elton. I'm with Graycroft. a early stage venture capital fund here in New York and LA. How many people know about Graycroft before I do the spiel? Okay. David knows. I've also done co-investments with David. So Graycroft, we focus mainly on digital media companies. We are located in New York and LA. We focus mainly on Series A investing, but we're very opportunistic, and we do have a seed program as well. What we focus on is simple. Our founder, Alan Patrikoff, is one of the first venture capitalists, and back then, most outcomes were pretty small, funds were small, it's very collegial business, and we've kind of taken that thread and carried it through to where we are today, and we think that's a very successful model. So what we do is partner with entrepreneurs. We focus on trying to help them build big companies, and what we don't do is let our sort of fund economics dictate things to our companies. So we don't need a board seat, we syndicate everything. We just try and help companies by making introductions. We have 40 or 50 events a year with all the top companies in the world. And we're not tied up on boards with accounting procedures and things like that. We just try and help companies. And the other things that we're not dogmatic about are like ownership percentages or like putting $10 million and owning 20%. Because we're a small fund, we just want to be in great companies and work with great entrepreneurs and have great outcomes. And the model's been phenomenally successful. Our first fund is done very well. Our second fund's done very well. And we're investing out of our third fund, which is a $175 million fund. We have over 100 portfolio companies. We do a deal about every 3 weeks, so we're very active and happy to talk to any entrepreneurs around. Thanks.
Thanks, John. I'm Todd Morrissey, a partner with LLR Partners. We are a Philadelphia-based private equity firm. We've been around for about 15 years at this point. Started back in 1999. We're investing out of our fourth fund, which is a $1 billion fund. And the exclusive focus that we've had over the entirety of our history is really partnering with what we call middle market growth companies that are oftentimes at an inflection point in terms of their growth curve and the maturation and evolution. We're often the first institutional investor in our companies, working with founder, entrepreneur-owned businesses. Although we do work from time to time with the earlier stage investors, the seed stage VC investors as well, to either provide additional growth capital support or liquidity, depending on what their desires may be. And the way that we define middle market growth companies are companies typically that have 15 to 20 million plus of revenue. They've established a business model, growing very rapidly for that scale, 20, 30% plus top line growth. And in those situations, our capital is focused on supporting the next stage of the growth. So taking a 20 million revenue business, growing it to 80, 100 plus million revenues over the coming 3 or 4 years. And to do that, we'll invest a pretty wide range. We can invest as little as $15 or $20 million. We can invest as much as $100 million. And our capital is very flexible. Our focus is exclusively on providing the support to the growth company, trying to find a strategic alignment of interests and a partnership mentality with the management teams. And our capital can go to support organic growth activities, acquisition strategies, recap dollars if there's partial or complete table. We try and be very flexible around the way that we structure our transactions. Speaking to that, one evidence of that, we are completely agnostic when it comes to whether or not we have a control ownership. Somewhat unique for when you're writing $30, $40 million equity checks. About half of the investments we've made have been in control positions, and about half have been in minority positions. Again, the focus is on let's find good growth companies where we have an alignment of interest, where hopefully we can add value beyond just the capital that we bring to the table, and the transaction structures will work out from there. From an industry standpoint, we're solely focused on high growth service-based business models, service-based end verticals, and beyond that, we again try and bring our value to the table, leverage our industry networks and our contacts. I personally have been focused on this space for the last 15 years. The most recent 9 years at LLR, where I manage our financial technology and our tech-enabled BPO investments. We also have dedicated teams focused on software business models, the healthcare space, education services, as well as government services.
Thanks, Todd. Vic Mehta, I work at J. Goldman & Company. We're a hedge fund based here in New York City. We've been here 27 years. The hedge fund's about slightly under $1 billion. I manage around 200 million of it. So I spend most of my time, 95% of my time, looking at things in the public markets. And that's what I've been doing there for the last 12 years or so. My focus tends to be around the internet. I'd say the global internet, because we've got teams or individuals rather paying attention to developments in Latin America, India, China, Japan, and Korea. Pretty much all different parts except for Europe, and there's not that much activity in Europe. So, of course, the U.S. as well. So, which is the lion's share of where we're deploying our capital. We've done well in our strategies over the last 12 years that we've been there with the positive returns every year. And the goal of what we're doing, unlike some of the prior commentary on this side of the table, we do have to pay a lot of attention to things like valuation. It's not good enough to like Facebook the story on the IPO at $38 when numbers are going to go down. But then again, when the stock is at $30 this year, on its way to 40 or whatever else, we're paying attention, trying to catch those moves up. So we spend a lot of time doing things like financial modeling, learning the companies, and getting to know them really well, and then paying attention to valuation. I made a quick list here of some great companies that traded at 10 times earnings, if people had done the homework. And here's the quick list. Google, eBay, Netflix, Priceline, Yahoo, and Apple. So if one was paying attention, you could have bought these companies at 10 times earnings. And in many cases, we were lucky enough to do so. So anyway, pass it on.
Thank you, Vic. My name is Jack Iacovone. I am very pleased to be considered a big fish in tonight's. As a 175-person firm, this is probably the first time that I've been categorized as that, so thank you. Needham & Company is it's a specialty investment bank, so what we do almost exclusively is work with emerging growth companies in technology and life sciences. So, for example, this year we've helped 20 companies go public through an IPO. We also do private placements. We do M&A advisory work as well. I've been with the firm 19 years, and as a result, I wear many different hats. I'm heading the investment banking group. I'm currently the head of M&A. I'm on the firm's operating committee. One of the unique aspects of our firm is we also have an asset management business, and that over my 19 years, I've worked with our private equity arm of that asset management business, and that was a $240 million fund that we raised in 2001. So I've personally been a part of 25 principal investments and served on 6 boards. So I think tonight the perspective I'd like to bring is sort of where the public markets, along with Vic, are looking, and some of the conversations that are taking place at later stage private companies. Thanks.
Thank you. Hello? Is this working?
Yeah.
It is, okay. So now what I'll do, I've got a series of questions that we'll ask, and basically whoever thinks they have the most interesting answer can jump up and say, I don't think we really have time to go step by step by step by step, and there's certainly no need for us to say, yeah, well, I agree with him, so next. So the first question is, we have various investors at various stages of company life, and each investor has a different entry point and an exit point, so liquidity. So my question is, how important is alignment of interest to the investors at various stages? And if it is important, how do you keep them aligned?
I'm happy to take that, but I need a mic.
Don't stick it anywhere.
Keep it clean. Again, you mean. So I was meeting with an angel investor who these guys would know well today, and he had a great quote for me, which I'll share with you guys. But he said, you know, he was having a conversation with another angel, and he said he was upset that, you know, this company that he had seeded kind of had graduated to venture and was doing well, but perhaps not paying as much attention to him. And his friend, this other very prominent angel, was like, you know, you're like the high school girlfriend, and now that they've moved on to the college girlfriend. So I got a chuckle out of that. But I think this is critical. You know, alignment of interest, not just amongst the investors, but amongst the company is crucial. You know, we have a saying where, you know, if if, you know, we're successful when the entrepreneur builds a great company that makes, you know, tons of customers very happy, and that company does well for its employees, it does well for its founders, and then we participate in that when it's all said and done, and the angels do well. You know, the bulk of the trouble comes when there's down round or something that's negative, and that's a failure for everyone. And, you know, I think if, you know, depending on where you're at in the stack, you know, we've all felt the pain of that at some point. And, you know, in particular in those scenarios, that's where alignment of interest gets more complicated. And that's where I find the bulk of like problems come from. So if you can kind of keep things simple in the front end and keep everyone on the same page, and by simple, you know, we have a saying where structure is the enemy of success in early stage investing. So we don't like to see, you know, big liquidation preferences and all sorts of weird things. We follow standard documents and things like that. So we're a big proponent of keeping people's interests aligned, making sure everyone kind of does well in the right scenarios. So.
Sure.
I think it's in the early stage, you know, structure could be a problem, but it could be a tool. And where everything is changing all the time in the early stage, the most important thing that I found over more than a decade of investing is integrity and respect. And if you have that, then everything ultimately works out. In other words, if you're an angel in a seed stage, first money in at a very low valuation, and because of the time and the situation in which you're involved, you get a board seat, you may even have a control provision ultimately for this. You have to be, if you're doing this seriously and appropriately, you know that when the college girlfriend comes in, let alone the trophy wife, that you are going to be, if not cast aside, you are going to be something of a fifth wheel in this operation. You will have done your bit to get the company going. You should feel good about that. And if you played it straight, and if you didn't put in a 7x liquidation preference or whatever, and you know, with non-dilutable, you know, board seats in perpetuity, ridiculous kind of stuff like that. But if you did it seriously and straight, and then the next investor is also playing by the same rules, straight and serious and respectful of you as an early stage investor, because without you, the company wouldn't have been funded to get to that stage in the first place. And the best VCs understand that. And when they're faced with a company that has angels in it, who are professional angels, I have never really had a problem with professionals and professionals. The problem comes when you have non-professionals on one side or the other, either angels who are overreaching or unprofessional VCs who are real assholes and who are trying to, you know, screw little guys and whatever. But if you're dealing with classy people on both sides, I have never had a problem doing this, because everybody realizes what the game is. We're all grown-ups, and, you know, as the people, you know, the golden rule of early stage investing is the person with the gold makes the rules. And so if a VC comes along and they've got, you know, they're putting in, you know, $10 million, and you've got, you know, a grand total of 500,000 in there should be appropriate differences in the way that happens. And if you had a seed board for the company's first board that consisted of, you know, you, the entrepreneur, and, you know, the entrepreneur's brother or whatever is who you accepted, and then it comes time to, you got a real VC in the mix, you know, that's not going to be the board going forward, and you will graciously give up your seat to the VC and so on and so forth.
So I'm going to skip around it because somebody mentioned valuations earlier. So the public market has seen some amazing valuations recently, certainly an example of Twitter. Is there currently a bubble, and has that affected valuations at your stage of investing, and should it?
So at our stage of investing at LR, again, we're investing in middle market companies, clearly pre-IPO companies, typically $20 to $100 million of revenue. You know, I think when we're looking at our technology investments, a lot of times they're technology enabled, and clearly people are looking at the public companies as a proxy. And if you see these 10 times revenue valuations or 15 times revenue valuations, it does trickle down. I think when you're dealing with the stage companies that we're dealing at, there's a sophistication and an understanding at the board level and at the advisor level that, you know, just because Google's trading at X doesn't mean that, you know, your $30 million revenue business, you know, should get the same type of multiple and same type of premium. So I think it hangs over everything, and it does factor into the valuation discussion. But you know, to David's point, I think there is, you know, reasonable discussions that happen around kind of company is at point A, wants to get to point B, how does it get there? And kind of just following up a little bit on the prior question that bleeds into this a little bit, the alignment of interest question becomes crucial on this. And I think when we get involved at the stage of companies that we're invested in, there's really two constituencies where you have to have that alignment of interest with your management team and potentially with your co-investors or the legacy, the VC, angel investors. And to bridge the gap and make sure that there's an alignment of interest may be different for that different set of investor. The management team, clearly it's going to be for us as the investor coming in, aligning their interests through equity ownership, focusing them on the value creation from an equity investor, shareholder standpoint, and also obviously having an upfront understanding for what the vision is for how we're going to get where we want to go, point A to point B. Everybody understands it's not going to be a straight line. When you're talking about alignment of interest with your co-investors, it does become more about valuation, and it does become more about governance, board representation. And I think in those discussions, Mark, that's where the public company bubble, if there is one, can enter into the discussion and create some gaps that need to be bridged.
So it's a damn good thing that 1999 thing came up for this panel, because we think a lot about that in the hedge fund world, and because naturally we've got the ability to be on both sides of that situation. I was on the sell side helping take companies public during the 90s, and in a period of 5 years I worked on 27 IPOs. I was an equity researcher at the time. So I would say if I was trying to pinpoint a time frame, we're somewhere in the middle of 1999. And if everyone recalls, we didn't peak till March of 2000. So things are expensive, but they're not stupid. We're using PEs, we're not using price to sales. But when things got really euphoric, there was a lot of price to sales. Jack and I were joking about this earlier. So there is another level of insanity above where we are right now. And let's all be candid in this room. The reason all of this is happening is because of one person, and that's Mr. Bernanke. So you tell me what he's going to do next, and I'll tell you the valuations and what directions they're going to take. Is it all going to play out in the same day? Probably not. You give it 3 months, you tell me what he's doing, I'll tell you exactly what these stocks are going to do.
Send him a thank you card.
Yeah, I would just echo some of Vic's comments in that it's certainly exuberance. I don't think it's irrational yet. It's probably irrational in certain pockets. Some of the SaaS companies, 3D printing, these are very disruptive technologies that are in the early stages. There's only 50 SaaS companies right now. There's 5 or 6 3D printing companies. One thing that Wall Street is good at is solving that supply-demand problem. So I think it's safe to assume that when I talk about all the bake-offs that are taking place among late-stage private companies, 50% are in software. So we probably will see a majority. We'll see that 50 public companies in SaaS double next year if these markets stay like this. So then winners will have to emerge. But the reason why I wouldn't say it's irrational just yet is there's high-quality companies trading at 10 times PE ratio still. Well, no, PE. No, the tech titans you mentioned. I mean, those are still quality companies you can get.
But they're not growing.
True, but what will happen is if it's irrational, they'll be trading at 25. That's what happened in '99. I mean, it just radiated out into all sectors of technology. So I think that's one thing, is that you still can find some value or a relative value. This question, now being called a big fish and a trophy wife in one night is really, I'm really glad I came. And the other thing I would just point out is that in boardrooms, when we're talking M&A of late-stage private companies, I would say 80% of the time, a company's pushed into a liquidity event when you don't have the alignment. So it really makes a big difference matching your investors as best you can.
Thank you. Okay, so at the earliest levels of investments, many angels drop out after several years when they truly realize just how long the investment cycle is and their powder runs out before liquidity events happen. Is this a problem? And if so, what can your stage of the investment cycle do about it?
The answer is yes, that is not atypical, because there is a very interesting pair of facts. And that is, if you look at the average IRR for serious professional angel investor portfolios, as has been shown in several independent studies, they range from 25 to 30% IRR. That's fact one. Fact two is that the average angel investor loses all his money. Okay, so you say, how do those facts get reconciled? And the answer is that the average angel investor is not a serious professional angel investor. It's a question of how you approach it. Most people calling themselves angel investors are really not of this class. They are tourist angels, they are people playing games, they are throwing money because Twitter is cool, so so Twitter must be great too. All the kind of people who bought TWTR before Twitter was even public. They see a friend at a cocktail party or the golf course and they throw money at it, and they're not doing it rationally. On the other hand, if you look at the returns for angels in groups, which is where those studies come from, like New York Angels that Mark and I belong to, and all these angel groups, you will find that if you do this rationally, you will actually, it's sort of hard not to get those returns in the long haul. The problem is, we were talking about liquidity before, and if you're in and out of the public markets, you can be liquid, depending on the size of your position, in 15 minutes. I wouldn't say 15 years for us, but the average hold for an angel investor is actually 9 years in the US. Now that's an insanely long period of illiquidity. There is no secondary market, despite what you might think from looking at all these things, companies named second market, which actually doesn't do secondary shares of private equities. So the average, if 9 years, we like to convince ourselves that it's really 5 to 6 years, and the new early exits world says it should be 4 to 5 years. But if you go in knowing what the real deal is and allocate your investment capital accordingly and your process accordingly, and are prepared to do this on an ongoing basis for that period of time, with appropriate amounts for follow-ons, but that doesn't mean you have to follow all the time. You can make money not following on. Many angels don't. But it's a question of understanding the rules of the game before you start putting money in this early stage.
But clearly, people do drop out before.
Absolutely.
Because essentially they run out of money.
Well,
Because
what
they
happened-
think they're back. So my question really is, as we go in that direction of the table, do you think it's a problem? Or do you think that's just part of the business, you don't care, for example?
Do you think that angels dropping out is a problem?
Yeah. At the next level, as you're funding mid-stage companies, I mean, at one level, you don't care if it's this angel or that angel.
Right.
But in terms of
It
formation.
becomes a problem. It becomes a problem if they're dropping out and potentially good companies don't have the funding to get to that next level of stage. So when we're focused on partnering with and investing in companies that have an established business model with great growth prospects, if they need the early angel investing, they need the early venture capital guidance and investments in order to invest in the infrastructure to establish that business model. If the angels are dropping out and it becomes pervasive across the industry, and all of a sudden there's a liquidity issue for early stage startup companies that can't get the necessary infrastructure and growth investment to get to that scale, certainly that becomes a problem upstream, just in terms of the available inventory of companies that reach that scale. So I think that's the way it would impact us. In terms of what can we do about it, again, I think it goes back a little bit to the alignment of interest question, which is, you get to a stage where there are angel investments, and now we're coming in at a Series B, C, or first institutional capital round. There needs to be a respect for the capital. There needs to be a respect for the folks that have gotten the company to that stage, and making sure that it's not a mentality where you're coming in saying, I'm the most recent capital in, you were common, you did a great job getting the company to this stage, but now I'm going to crush you, you have no voice, and I'm going to take all the economics. That type of mentality, I think, is counterproductive to the company's benefits and to everyone's benefit.
So let's starting at the other end. So what are the biggest challenges each of you faces in sourcing investments? And let's combine the question, and managing the portfolio itself.
I think for our model was somewhat unique. We had 71 CEOs who were limited partners who helped us source investments, which was a big asset to us. I think the biggest issue we faced is that we're just not a brand name, and people in general aren't going to pick up the phone and reach out to us. So it is a lot of legwork that we have to put in to maintain, the 1,000+ investments that we would look at each year.
Our job is easy. We wait for folks like Jack to call us on the next IPO, and then we figure out whether or not we were commenting on that earlier. So the IPO activity is frenetic right now, and doesn't seem to be stopping. And my job becomes trying to figure out which ones are going to be real companies that are going to be big. I mean, there's some terrible statistics that associated with IPOs. You know, a year past the date of an IPO, 50% of these stocks are below where they went public. That statistic has been around for decades, and so, you know, participating in the public markets, these things seem very tempting, but the reality is for every one Google, you're going to get 100 that are pretty lackluster. So, and then you're going to get a whole bunch of them that are, you know, 1, 2, 3 baggers along the way. So, and mind you, Google's gone from 85 to, you know, 1050 or wherever it is right now, but that was a 9-year process with lots of ups and downs. So there's a ton of product, and there's more of it coming. You know, one of the things if there's a simple tip or a reminder, I guess, is you see a company go public, don't invest in it. Go into your calendar, give yourself a reminder about 6-7 months from the date you're sitting at right now. And there's a big lockup. That's when the insiders can all sell stock. It's a good time to, the benefit you have then is the company's been around for 2 quarters as a public company. You've started to see the numbers. And now there's not as much inflation associated with the supply-demand imbalance. So you just sit and wait. This is what institutions do all the time. So we build initial positions in the IPO, right, initial public offering, and then we wait till the secondaries that come 6 months later. And that's when we actually load up. So I would say that's one way to deal with the situation. And on the high-quality companies, you'd be surprised how you might be able to get them at decent prices.
For us, I think the sourcing question is interesting, and it certainly has evolved over the last 10 or 15 years as the market has gotten, I think, much more sophisticated. Again, talking to companies that have 20, 30, 40, $50 million of revenue, they've been through the process before. There's going to be a sophisticated CEO, there's going to be a sophisticated board, there's going to be a sophisticated advisor. And so really at that end of the market, there's a couple different ways that you can source investments. You can, you know, to Vic's comment, you can sit back and wait for Jack to call and say, here's an interesting company I'm raising capital for, do you want to be involved in a process? There certainly is a lot of deal flow that comes through that channel. But the more interesting deal flow and sourcing opportunities are going to come from, you know, I'll use the term proprietary loosely because I think at that end of the market, a truly proprietary deal is difficult to find, but that's sort of the holy grail that we're all looking for in the private markets. And we, you know, our first fund back in '99, I'd say probably 75% of the investments that we made in that fund, 20 or so companies, were proprietary or pretty close to proprietarily sourced in terms of we knew the entrepreneur through our network, we were able to strike up a discussion one-off. You know, the days of being able to invest $1 billion fund in all proprietary deals, that's very difficult. And so what we've had to do over time is really develop a multi-pronged approach to our sourcing efforts. As I mentioned, we've got industry teams and an industry specialization where we've got 4 or 5 dedicated investment professionals in each industry who are tasked with knowing who the thought leaders are, knowing who the companies are, and really owning the knowledge base of the trends in that industry. And so they are tasked with that sourcing effort. We also have developed over the last 4 or 5 years a pretty sophisticated and exclusively focused business development effort. We now have 3 full-time business development folks who are focused exclusively on going out, marketing, meeting with companies, getting the LLR name out there. Tim Foster, who's here today, is now doing that for the last 6 months, starting up our effort. Resident here in the New York City market, we've done that in DC, we've done that on a national basis as well. And then the other thing that we've done that I think you probably hear private equity firms talk a lot about is we've built an operating partner network. Semi-retired executives who don't necessarily want to play golf 7 days a week, maybe they only want to play golf 3 days a week, and the other 4 days a week, they are advisors to us, and we can leverage their network, their Rolodex, and it's another way that you can differentiate yourself and really, again, speaking to adding value beyond just the capital. But the market from a sourcing standpoint has gotten much more sophisticated and much more competitive. Rarely, if I talk to a CEO, rarely am I the first private equity or venture capital firm that's called them. He probably has a list of 50 other firms that have called him at some point in the prior 12, 24 months. And so the question isn't so much how do you find the deals, it's how do you differentiate yourself when you do find them.
Sourcing is an incredibly important part of what we do, and we have a very, not sophisticated, but we're very operationally oriented on these things. And, we see about I think on this Monday we had 78 companies to review from the prior week in our New York office. So we see a lot of companies. But the reason why I'm here and why my partners are all over the place all the time is because we always want to find great entrepreneurs. And so I would say that, to answer the question, that our biggest challenge is probably signal to noise. There are just a lot of companies out there that may or may not be a fit for us, but come through our door. And some of those will go on to be great companies, but they're not for us for one reason or another. But I would say that's my biggest challenge is, you spend a lot of time meeting with people, and I enjoy that. That's what I like doing. But it's really about finding those gems that you fall in love with. That you can you partner up with someone and really try and build a big company. I saw a quote today which I think kind of sums up well how I think about it, which is when I find a company that I want to join or run or whatever, that's when I know I found a really good investment for me. It's like if you can imagine yourself loving working there for 7 years or 10 years or whatever it takes to get to a really big outcome, that's a good company.
Our end of the world is in the part where the biggest change has probably happened over the last decade. When I first started as an angel, the biggest challenge in the seed stage was finding companies, because these are two guys in the cat or whatever starting in a garage, and how would you even know that they existed? How would they know that you existed as an individual angel investor? I mean, if a company's looking for money, angels don't walk around with big dollar signs saying, hey, I'm a rich guy, come hit me up for money. By the same token, if they're sitting in their garage working on their product, I'm not going to look in their garage, peek in the window to try and find them. So developing any kind of deal flow was really challenging, and that's why Angel Group started in the first place, so we actually could put up a website and say, hey, New York Angels, we fund seed companies, come here, and we will go out and speak at various places and try and get people in the door. What has changed drastically over the last decade with the advent of the internet and the dropping of costs of capital of starting companies, the cost of what you need, and the explosion of early stage investing, has now been between platforms like Gust. I mean, Gust has nearly 250,000 companies on our platform. 250,000 startups. We have something like 7,000 or 8,000 companies every month who are coming onto the platform, and that's more than the deal flow of the largest VCs in the world. Between platforms like Gust or like other ones in the space, like AngelList or Crunchbase, or things where you can now find companies, finding a company ain't a problem. There are a zillion of them out there. The problem has now become one of curation. And that's what's really interesting, because there have been, at the same time that you have this fire hose of companies that are looking for money has kicked up. The challenge is to figure out the signal to noise ratio against this enormous base. And you have the world of accelerators, things that were started by Y Combinator, and things like Techstars and NYC Seed, and a host of specialized accelerators in different areas. What they do, they're very, very selective, and they help, they will often take 1 or 2% or 3% of the companies who apply, they'll run them through a 3-month program, and then at the end, they will have a demo day. And so the demo days are sort of becoming the new normal, whereas, so here you're looking at these accelerator demo days or these pitch competitions at business schools, at Pace and NYU and Columbia. You're looking at conferences like Business Insider and Demo and Launched and Disrupt, all of these things where now angels go to find deals, and you'll see hundreds and hundreds of potential companies there, but those are the ones who have survived this winnowing out process of the 100 other companies who applied there. So the challenge that we have now is one of curation, finding the best deals out of this fire hose.
Okay. By the way, just for those of you that are thinking about it, the various demo days, and this is for a topic for another seminar sometime, the various demo days start running afoul, or potentially running afoul of the new Jobs Act and restrictions and general solicitations. So before you just run off to the next one, at least pay attention to that. So I have a tandem set of questions, and that is, what are the most common mistakes entrepreneurs make in raising capital? And on the other side, what are the most common mistakes investors make investing in technology companies?
I'll take the second part.
Okay.
I'll take the first part is that an entrepreneur has an idea. Okay, I'm ready for an IPO. I mean, every single entrepreneur I've ever met, first of all, they confuse idea with execution. So, and they all think that having the idea is the critical part of doing the startup. There's a wonderful post by a guy named Derek Sivers, who's available on his website at sivers.org/multiply, which is that his point is that execution is the multiplier of ideas, and the real value comes from the execution, not the idea. Entrepreneurs don't get this at all. But even if they have executed, which to them means they've got a prototype and they've got 2 or 3 beta users over there, well, they're definitely, of course, now ready for venture capital financing, and so they go up and they beat down, Breakroff store, and they're going to Kleiner Perkins, and they're and because the only stories that you see in the media are TechCrunch stories about so and so getting funded for $50 million, or Instagram getting $1 billion offer after 23 months. They all judge themselves by that, not realizing that is way the outlier. Where in reality what has happened is the bar now has raised so high because it's so easy to start a company. We at our earliest stage, we're the little guys here. We expect companies to come to us with a product, with customers, probably with revenue at this point, showing that they have proven the baseline idea of what they're doing. It used to be people would come to us for the cash to do a sort of proof of concept so they can go down the line over here. Nowadays, anybody can get a web app going or a mobile app, so we expect, and that's the entry level. We expect them to have done that and then proved it and then come to us. And so misjudging where they are in the process and what kind of capital they're looking for is the biggest challenge that I see.
And on the investor mistake side, unless you want to.
We don't make mistakes. What are you crazy? So I actually think it's the same thing for both sides of the table, which is not thinking long term. There's, we see very hot companies that come in the door, and they've got 6 or 7 term sheets from all the top funds, and it's like, can we get an answer in the next 3 milliseconds, and yada yada yada. And the reality is people talk about it's more like a marriage, or it's like when you take in an investor, it's like having another family member. I mean, it's someone that's intimately involved in what is one of your most important parts of your life, which is your startup, and that's going to be a long-term relationship. And so what I see mistakes on both sides, investors who kind of get overeager and are like, in my opinion, perhaps don't do enough due diligence. And then on the flip side, entrepreneurs not doing enough diligence on the people that they're going to work with. And, so I would encourage all of you, if you're considering these kinds of things, to do your diligence on your investment partner, to take the time to really understand, have the tough conversations up front. Like, what do you expect, if you pitch a investor and they're not asking you, like, what do you want to do with the company? Do you want to have a IPO? Do you want to go? If you're not having the kind of difficult discussions up front, that's a bad sign, and it's a sign that one of the parties is not thinking long term. So I would say that's the thing that I see, number one, from both sides, that just constantly comes up, and it manifests itself in a lot of different ways, from getting overeager on valuation, putting a strange syndicate together, having someone that knows nothing about the industry involved in a very early stage endeavor. So that's my comment.
Just following up with that, one other point I'd make before Vic talks about the mistakes that investors make. I would encourage all the entrepreneurs in the room. Oftentimes what I see as a mistake is underutilizing your financing partners, your board members, and the value that they can bring beyond the capital. So all the entrepreneurs in the room, I would encourage you to think about who your financial partners are, what additional value can they bring to you. If you have a problem, an opportunity, or a challenge, chances are that the people that you've brought into the company as financial partners or board members, they've either been down that road before and may have some interesting perspectives, or they will know somebody. Tap into the network, the resources, and really view your board and your financial partners as a resource that you can leverage, another arrow in your quiver, so to speak, that you should constantly be thinking about how best to leverage that.
Here.
Two parts of that, of mistakes that are made, either from companies who are, the management team who are running those companies, or investors. But the one that I've seen that's relatively frequent among companies and the management teams is bad acquisitions. And unfortunately, you don't know about it till much later, after the company's been digested and half the talent is left or more than that, and you know, the original revenue stream that you thought you bought doesn't really exist anyway. And so there was motivated sellers or whatever that got the deal done. So that's unfortunately a very common one, and that, you know, sitting in my seat, that's something that I have to evaluate a management team with over time, right? You're dealt the hand you're dealt with the business you're running. You can alter that hand by the strategic moves you make and which businesses you acquire along the way. So if you make mistakes along those fronts, well, you're gonna be dealt a pretty harsh sentence at the end of that. So that's where the management teams mess up in the public markets. For investors, I think investors, the common mistake in tech is there's a very common philosophy of, well, if they grew 20% last year, well, they'll grow 20% this year too. But anyone who operates and lives in the tech industry, you know that whatever the industry moves so fast that last year has got nothing to do with this year. And the product pipelines and the competitive dynamics are continuously changing. That's what we do, that's what my team does. We're continuously in there at industry events, talking to all the different players in the industry to understand how fast the sand is moving around. And when we can figure out, I'll use Apple as an example. Apple traded $700 last year, then this year traded $385, right? I was telling you, you could buy these great companies under 10 times earnings. You could have bought Apple at like 6 times forward earnings, once you strip out the cash. I mean, that's Apple. I mean, it has a dividend, it had 3% dividend. You could have made 50% in Apple this year, just in the last 4 or 5 months. So what was the mistake people made last year at $700? They thought that the iPhone 5 was going to be a great product. As it turned out, when it came out, it was the iPhone 4S, just slimmer. Didn't create enough demand, right? That's not a good reason to keep owning a stock. As it turns out, the 5S is a phenomenal product with a massive software upgrade and a better processor, much faster processor, twice as fast as the one that was there previously. So around those themes, we were buying the stock, and I think that's why there's true demand for the product right now as well as for the stock. And that's why we're seeing the stock go up.
Just one brief comment on the long-term elements that John was speaking about. I think entrepreneurs often focus too much on dilution. And when you look at the realities of venture-funded companies, 80% are probably going to have unsatisfying outcomes. And the 20% that are satisfying, a few percentage points is not going to matter. So I think getting the right team in place, people you're comfortable with, people that can help you leverage, you know, your business to where it needs to go, build your team, etc. That's much more important. So I would just say that that's a common thing that I see many entrepreneurs really focus on the dilution, and it, you know, that's a little bit short-sighted in my point.
Hello? Okay. All right, so this is a three-parter. What do you consider a successful investment, and consider it the prospect as you're looking into the future? If there's a follow-on at the age where we're talking about, at the stage where we're talking about follow-on, increase, changes in valuation, and at the exit. Should we start with the smallest?
Well, since it's in front of me, I'll just give the quick answer. I think we measure success ultimately at exit, which is sort of your performance. And I think the interim fundings, the up rounds, they give you an indication of how you're doing, and they certainly can kind of use that as a guidepost for, are you on the right path? Are you creating value? But at the end of the day, our limited partners, our investors, our customers, if we have a lot of positive prospects and indications along the way, and it ultimately doesn't pay off, you know, it's hard to call that a success. So ultimately, it's dependent on kind of what the ultimate return is at exit.
Obviously, we're in the financial business, we're investing in companies, so you want to make money, and that's the primary thing. In terms of how much money you want to make, at the early stage, the way that investors and angels get that 25% IRR, rather than spend 5 minutes doing the math, I'll cut to the chase, which is that each individual company has to be modeled out to return a 30x. 30x. Because it's such a risky business that you're talking about the risk increases as you come down to this end of the table. And with the majority of companies failing totally, and the ones that succeed, they succeed, either you get your money out in an acqui-hire, or you get a couple at 2x, and if it was okay. And that one last company, which you're now holding for 5, 6, 7, 8, 9 years, has to make up for the entire return of the entire portfolio. And for that, for example, to return 25% IRR across your entire portfolio, it models out, you have to look at 30x. And see, since you don't know which company is going to be the one standout in the portfolio, you've got to make sure that every company that you model can do a 30x. So that's the financial end of it. But the one thing that sort of differentiates us is that in the angel world, there is one additional little thing. It doesn't in any way replace the economics or the 30X, but it adds to it. And that is the psychic benefit and the reward that you get out of it. Because we're working really closely, typically upfront with a seed stage company, typically a first-time entrepreneur, and some of the best returns, other than financial, which is the primary, again and again, financial is the most important thing as an investor. But that being said, watching a CEO, a first-time entrepreneur, turn into a CEO and grow with a company and end up running a 100-person company with real revenues, that's created real value, and in the process learned, this is an extraordinarily heartwarming thing. So that's one of the extra added benefits on top of the cash.
So Vic, I gather you'll settle for 29X?
Yeah.
All right, so thank you, everybody, and now we're gonna open up the floor, and whoever raises up.
Hi, great panel, by the way. I'd like to ask you, seed and venture guys, you talked a little bit about seeing some revenue. What, in the most specific terms that you can describe, or maybe using examples, what to you is satisfactory evidence of a revenue model for a company that you're comfortable investing in that?
So this is the question that venture capitalists hate to hear, which is, we'll say no to an investment and because there isn't enough traction, the question will be, well, what's enough traction? And so here's my answer, and it's not the answer you want to hear, but every company, like in my prior life, I was an investor in 2 e-commerce companies, and both did very well. And what was striking to me was they both had incredibly different metrics. And so if you ask me, like, what of those 2, which are e-commerce companies, what are the metrics that are important to those? They're actually drastically different. So the way that I answer it is, it's unique to every company, and there's a magical equation of CAC, cost of acquisition, the lifetime value of a customer, and those things have to work in concert to add up to what to us makes a good business. And obviously a huge part of that is growing fast. And at the stage that we invest, you're never going to have enough information where it's like you're checking the boxes and it all adds up, and you're like, okay, this is like a no-brainer, it's going to be huge, and there's always boxes that are unchecked, and you don't know how it's going to work out. So it's not the answer that you want, but I think for me the reality is it's very individual to each company, and what I encourage people to think about is kind of prove, what are the metrics that you look at, that you run your business by, and where you can kind of come back and show me that if I just draw the lines forward and it kind of continues on here, or if I just solve this one other thing, it really takes off. That's kind of how I think about it, and I encourage people to kind of when they're pitching me to kind of walk me through that, and if that works, I'll get excited about it. But there's no magical if you cross $1 million in revenue, at least not for us, then there's enough traction. Some companies need a lot more traction to really prove out things. Some you walk in and it's going to work, and they kind of spell it out. So it really depends.
Yeah, I would second that, and I would say that this is the equivalent to saying, how much cash does the entrepreneur need to have invested in the company before we would invest? So every investor at the seed stage will tell you we need to have the entrepreneur have skin in the game, right? So if you don't put your own money into a company, there ain't no way nobody else is putting a penny into that company. So the question logically that follows is then, well, how much of my money do I have to put in? And the answer is, it depends, because it's the theory of putting your own cash in. It's the principle of it has to be meaningful to you, that we really want your skin in the game here, right? So the answer to that question would be very different if you're talking about an 18-year-old kid who had saved a total of $5,000 from a paper route, was putting $3,000 into a company, versus if Bill Gates comes around looking for an angel investment over here, we hope there'd be a little bit more invested in the company.
I can't resist adding my 2 cents to that, because to me it depends on the amount of money you're looking for and what you're conceiving of as the valuation of the company. if it's at the earliest level, just prove to me that somebody's willing to pay you something for it. And, you know, as opposed to just, we'll use it for free. And if they are using it for free, at least have an agreement that says that when you've proven that it works, how much they're gonna pay you. Over there.
This is kind of
Yeah, please, why don't you stand up, because you're at the end.
This is kind of a related question, but for an entrepreneur, when is the right time to begin talking to a seed stage investor? Given what you said earlier about the thresholds of this point
Right.
being revenue, et cetera, when do you actually begin the conversation?
It's a tricky thing, and it's changed over time, and you'll hear different things from different people, right? Some people tell you, well, you should start socializing your thing among investors and taking them for coffee, and but in the real world, how many, you know, we can't possibly, he's got what, 75 companies a week or whatever he's looking at. I mean, you know, New York Angels receives over 100 applications every month for funding, and we're volunteer part-time angels, right? So we only can look at a company when you're ready, you know, we want a decision, yes or no, right? Please don't socialize in advance, although that might in the previous world have been. By the same token, if you're not ready to be invested in now, it doesn't make any sense for you to start pitching us. So therefore, the question is, what does it mean to be ready? And that's what we've been getting to over here. It's the traction question. It's the not just an idea, not just a business plan. I would say today, even at the seedest of seed stage, which is what Mark and I do, you had better darn well have a company that has shown that you have an idea, that you have done something to instantiate that idea, that the market has done something to prove that that idea actually makes sense, and somebody is willing to pay to write a check for what you're doing, and you're coming to us now, traditionally at where you would have come to a VC, you know, 10, 15 years ago, which is to throw money on the fire to make it go forward. But at this stage, we're expecting that you will have gotten to something starting so we can now provide additional cash. And it's tough for an entrepreneur because that puts the burden of getting the whole company starting and up and functioning on you. But the good news is, such as it is that it's now much easier to do that with all the dropping costs of, you know, cloud hosting and open source and frameworks and everything that's out there. You agree, Mark?
Absolutely. There was another hand. Go ahead.
How is crowdfunding, the new SEC rules, despite what the SEC would really like to do under the Jobs Act, they've been forced to allow kind of crowdfunding? How's that going to affect? I don't think it affects the right side of the table, my right side. I think it's you two guys. It's got to affect it somehow. And in a world where, I mean, New York, the ecosystem for angel investing is dramatically different than it was just 10 years ago with the number of incubators and the number of groups. And David knows for sure because he's been doing this a long time. So the VC, there's an angel investor on every corner. How's that going to change now? How will the New York Angels, for example, change when crowdfunding comes in? And have you invested in one of the platforms?
So the answer is a whole lot and not at all. And the answer is yes, I invested in a bunch of platforms. I mean, obviously, Gust itself is the biggest, you know, in the industry, hands down. We're not doing transactions yet, but you can draw the line and you see where we're going. I've invested in a company called Bolster, which is a sort of Main Street America crowdfunding platform, Realty Mogul, which is real estate crowdfunding, Crowd Supply, which is sort of a product crowdfunding. I believe that there are two parts. By the way, the Jobs Act, for those who aren't, just quickly bring them up to speed. Last year, Congress passed the Jobs Act 2012, which for the first time allows people two things. Non-accredited investors to invest, people who don't have $1 million or $200,000 in assets, to invest in private companies effectively. And the other part is it allows companies to say they're fundraising. And these are the Title III and Title II respectively. These are very different things and will have very, very different effects. The Title II change, which says companies can now what's called generally solicit or tell people they're fundraising, is going to fundamentally, and has already begun to fundamentally change the way this whole world works. Until this past year, for the last 50 or 60 years, companies could only raise money from accredited investors, but they couldn't tell anybody that they were actually raising money. So you had to either know the investor or be introduced by a broker-dealer. You couldn't put an ad in the bus saying, hey, fund my cool startup. That changed with this regulation. And so that's the thing that has enabled all of these platforms, all of the Circle Up and Funders Club and Angel List and everybody else out there. And so that's going to be a major change, because for the first time it will enable online widespread distribution of this fire hose of companies. That's really important. All the press, however, has gone to the other side, which is the Title III stuff, which is the unaccredited investor, non-accredited investor crowdfunding of $10, $100, $1,000 into these things. That's getting an enormous amount of ink in the, or virtual ink in the blogosphere, and I think at the end of the day, it's going to result in sure, a lot of projects and things getting some seed capital, but it will have virtually no effect at all, I think, on the bigger economic picture.
John, you want to see how it?
Yeah, I'm very intrigued by the whole area. We're, I'm on Angel List. I'm sure we're on Gust. And actually, I have a personal an angel investment of my own from prior life that just went through the process and raised some money and got some really value-added investors as a result. So I'm a huge fan of it. I actually do think it's going to be disruptive. I don't know that it, I think what David is saying is I don't know that it's gonna I think some people predicted it's gonna fundamentally wipe out the venture industry or do other things. Will that happen? Will that be the thing that does that? I doubt it. But I do think it's a very interesting endeavor, and I think it's gonna help improve funding for startups, and these platforms will evolve and get better, and people involved will get better, the companies coming out of them will get better. It's very early days. We're intrigued by it.
Thanks. Georgia Quinn. Just along those same lines, and to get the guys on the other side of the table involved, one of the negatives about crowdfunding is people are worried that by having such a broad investor base, when they move up, a broad and more unsophisticated investor base, when they move up to the second and third levels of financing, that will be, a detractor from the more sophisticated and the bigger shops investing. And I just wanted to get your thoughts, if you thought that was a true concern, or if something was publicly tested and the crowd approved and it was successful, would that stop you from making an investment?
I think there's a mini case study of that with one company, and that's Facebook, right? It got all the euphoria and lots of investors who jumped in at the early stage, and I think that IPO was set up miserably, and that was one of the reasons, because you were guaranteed that as time went on, there were a lot of people who had gotten in who were looking to get out, and it set up the stock miserably. So if that's the precedent, I can't think of another one where there's so many,
Individual.
yeah, that were all lined up, and maybe we'll see more over time, but.
Yeah, that's the case study though.
So the direct answer to your question is that if crowdfunding were to be, unaccredited crowdfunding would be carried out the way it was originally envisioned, which is individual people, putting in $500, $5,000 into a company, so you have 100 people on the cap table, that would be a killer. I mean, we would not, a New York Angel ain't gonna invest in a company like that, let alone any guys later down the street, because that's a recipe for complete and total disaster for about a dozen different reasons. That being said, because of that, what you're going to see is it's not going to evolve that way. Instead, it's going to evolve through the use of some type of other vehicle, either revenue appreciation notes, which we think actually makes sense, special purpose vehicles where all of the crowd invests in one vehicle, which in turn invests in the company, which is the way AngelList is currently doing syndicates. Or if it's Facebook, if I'm in Facebook, it doesn't matter at all whether I invested at $1 million pre, $2 million pre, $5 million pre, $20 million pre. I'll do very well, thank you very much, on Facebook. And you know what? If it ain't Facebook, it doesn't matter. It's not going to move the needle at all, so I don't care. So therefore, the only question I have to face is, can I get into Facebook? So I got to get into the hot deal a day, and therefore I'm completely valuation and structure agnostic and everything else. Okay? The New York approach is the one I just gave you the end line, bottom line math on, which is the East Coast, which is the sort of financially, long-term thing, which says, okay, roughly 1 in 10 companies has effectively a home run exit, and the typical M&A acquisition for these early stage companies is between 30 and 40 million bucks. So therefore, if you do this across a whole portfolio, and you don't happen to hit the 1 in 10,000 Facebook, but you hit the 1 in 10 that's going to give you a 10, 20, or 30x kind of deal, which is going to have an exit at 20, 30, 40 million, 100 million, whatever it is, then you back it out and you say investing rationally. I don't have to rely on the one bluebird for Facebook and then everything else blows out. It's a matter of what they do, because if you're relying on getting one Facebook and you don't get into Facebook, but instead you get 10 companies in your portfolio and they all have, you know, a moderate exit, you know, 2x with whatever, you know, they were, but you were investing at these enormous numbers, it doesn't work. So the East Coast tends to have what I would consider a rational, financially oriented structure to it, whereas the West Coast has very much a swing for the fences, all or nothing, social proof kind of scenario.
It begs the question about if you're a young entrepreneur, maybe you should just get on a plane. But
No, but I think that there's a different reason for that. I'll just state it very quick. I mean, name 5 companies that are on the East Coast in the tech industry.
yeah,
Name 5 companies in the East Coast that have a market cap north of 10 billion that went public recently. East Coast. There aren't that many. West Coast, different story.
I guess for a budding investor slash entrepreneur, is there a particular form of incorporation that you all across the table
Delaware
tend
C
to
Corp.
prefer?
yeah, Delaware.
Delaware C Corp.
Delaware C Corp.
Not Nevada.
You know, on the West Coast, you're seeing some maybe 10, 20% Nevada, but it's Delaware C Corp.
You know, from a governance standpoint, I agree. The other consideration though would be C Corp versus an LLC or a flow-through entity, and there are going to be tax implications that, in terms of how you want to structure that, which, you know, is one of the things that we actually set up our fund somewhat uniquely. We have an ability to invest directly into flow-through entities that has some economic and tax benefits that you should think about. But clearly, in terms of governance and legal aspect of things, Delaware's the way to go.
That's not to say it's not worth starting out as an LLC as long as you have just your money. It depends on the amount of time that you're going to be running as the sole owner or the small group of what ultimately become common shareholders. There might be benefits in a year or two, and then just going through the conversion.
There aren't any lawyers in the room, are there?
Okay. There was somebody else that had a hand.
No, it was Teresa, but can you repeat again that part about you investing directly into the fund? So how was it that the tax structure that you were mentioning?
Well, there are certain tax attributes that are unique to LLC structures versus C corps that can create meaningful economic tax advantages at the time of a transaction and at the time of a sale. A lot of partnerships, there's a pretty complex implication to that to the investor base, but a lot of private equity funds, venture capital firms have an ability to invest in and maintain the flow-through entity structure, but have to do so through a blocker corp. And again, it gets very complex, but if you have an ability from the investor standpoint to invest directly into the LLC, instead of structuring where you have to invest into a new co that's a C corp that then invests into the LLC, that's just a different dynamic that creates different tax attributes. And happy to talk offline to you or anyone else about it, but it gets to be pretty complex. And the lawyers in the room, you know, are drooling and are much more up to speed on the implications of all that.
Can you talk about the orphan Series A companies?
Orphan Series A companies. I mean, we're primarily a Series A investor. We do have a C program. We're very opportunistic. And, you know, it's sort of a tale of two cities. There are Series A companies that are incredibly hot right now. We just had one last couple weeks that had just incredible interest. They actually took a term sheet that was 40% below what the top one was and got an incredible partner, but they had great choices. And then there are the folks that don't have the astronomical metrics, and I think the challenge there is that, you know, because of the lowering cost to start a company, and the, you know, there's just been a tremendous amount of interest in seed and early stage investing. There are just a lot of these, and you know, since the bubble burst, the, you know, number of investment professionals, especially focused on Series A, has at least halved, and some of those people are actually not active investors anymore, so I think it's actually underreported how few there are.
I want to get your perspective as far as not only that particular issue that people have been telling me, listen, may want to go to California, but also what's the value add here? That
Clearly the weather's better.
And how would it make probably more important?
That's a legitimate question. The question is, if it's so easy to get money in California, question, and for a New York entrepreneur to move to California and get the easy money, the easy dumb money instead of the New York, smart money. The answer to that is, first of all, sometimes it does make sense. But just because so what I was talking about was in terms of valuation, right? It's not that money grows on trees in California, because you have a whole lot of companies. If you take a look at the number of companies that are coming through Gust, the absolute largest in terms of numbers is in California, right? And so the funding rates in the Valley are not higher than they are here in New York. So you're competing with a lot more companies. Valuation, if you get a deal in California, you may well get more cash. But it's not going to be easier necessarily to get money out there. The other question, but in terms of what the value add is, this is an important thing. Now, money is increasingly fungible. It's become a commodity, and the question is, what are people going to add? And so if you take a look at some of these syndicates and the money coming in California, it's not particularly sophisticated money. It may have a name that was successful in something else. It may not add to you. Here in New York, you just take New York Angels as a group, where we have people who really can spend a lot of time with a company and have expertise in a particular area, in a field, in management and structure. We spend a lot of time with our companies in mentoring. And if you're talking about a group in California that may have 500 investments over there, it's hard to get a lot of face time and support. So one is not better than the other. They're just different.
I would just like to add to that, to answer that, the wow factor. Out there, it doesn't wow people. It takes a lot to wow the investors. And here it's publishing all the different vertical markets.
We're simple. It's easier to wow us.
Yeah.
There's another factor here, and that is, if you're investing a lot more at a higher valuation, as you go up the food chain, your market has to be bigger. So if you're not building everybody builds a company for the idea that they have, not for, well, I'm only going to do this if it's a $100 billion idea. If you have a $10 billion idea, that might not be so terrible.
And by the way, that's the Series A crunch. The crunch happens when you have all these companies that are getting funded at valuations that require a Series A and a big Series A to make sense, and you don't get it. So you're seeing, I think, many fewer companies on the East Coast where you had sort of really structured investments that made sense from people looking at the numbers. Oh, God forbid they look at the numbers, but we looked at the numbers, and so you don't get into the situation where you get overvalued. If you think about it for a second, if a company raises money at a 10 million or whatever is post, and you're trying to get even a 20, forget the 30x, right? Trying to get a 20x. That means the company has got to sell with no further investment for $200 million. And I got to tell you, sure, Twitter did, right? But I mean, I have it in my portfolio, had a 200 million exit, had a couple 150 million exits, which are very nice, thank you very much, and I did very, very well, but no $200 million exits. And so if you think that you have to make that $200 million exit to make sense, tough.
Yeah, we're active on both coasts. So we have New York and LA, and I'm doing a deal right now in San Francisco. I think the interesting thing for me is, the hottest company right now in the world is a company that's based in Iceland. It's a company called Plain Vanilla. We seeded it. It's been the fastest growing app on the App Store. You should all download it. It's called QuizUp. Your kids probably have it already, and it's a lot of fun. It's highly addictive, so I warn you. But what's interesting about that is that I love the Valley. I've got friends there. I've got portfolio companies there. It's a great place to invest. And I think the interesting thing that's happened is that people have kind of learned from the Valley, and a lot of people are thinking big globally. And here in New York, you have the nexus of 7 global large industries. And those haven't had the massive transformation that technology has had, where the Valley is traditionally operated, and so some of the bigger companies are in these markets that there's the talent pool, there's capital, there's people who understand it and are able to scale these larger business. We're an investor in a company called Buddy Media, which is a social media monitoring company. A lot of large advertising agencies are based here in New York. And they were able to scale a lot faster than a lot of their competitors here in New York. We're investors in a company called Maker Studios, which is based in LA. They're the largest YouTube affiliate. And, guess what? There's a tremendous amount of talent and expertise around creating content in LA. And, you just don't have that in the Valley. So, I think that's the fun, interesting thing that's happening now. It's like entrepreneurism is exploding. Everyone's kind of getting it and swinging for the fence and thinking big, and it's kind of a global phenomenon. But, are there attributes of the Valley that are hard to, there are certain things that I think the Valley does very well. Like if you're doing a search technology, like, if there's 1,000 engineers that really understands, scaled search, 900 of them are in the Valley. So there's attributes, grass is always greener, but I think there's a lot of interest around these, outside of just the Valley.
And there's a reason, by the way, that New York is growing faster than the Valley. New York is the fastest growing tech ecosystem in the world right now. There are over 10,000 startups within the 5 boroughs of New York City. And so on an absolute basis, we're number 2 to the Valley, but on a relative growth basis, we're growing faster.
Yeah, I'm just interested in, from a business that's been angel funded, right, and you're thinking now about where do I take it for the next round? Do you go and just do a follow-on? Do you do a follow-on with a VC? And, some angel groups I see now, they just want to keep it in the angel community because they don't want to deal with the VCs, and they, the businesses sort of take a different path.
It's not for the angels to decide. It's for you to decide as the entrepreneur. And the bottom line is, and it's not even for you to decide, is for you to accept reality and figure out where you are. If you are in a position where you can get venture funding for near that stage, then take venture funding. And if you can't get venture funding because the venture capitalists won't fund you, but your angels will take a deep breath and do a follow-on, then that's what you'll do. And if even your angels won't do a follow-on because they don't think you're there, then you hunker down and you slice and dice and you try and live to see another day.
I just had a comment on the difference between New York and the Valley. And when I grew up, I always wanted to be a baseball player, and Babe Ruth and being a New York Yankee and Yankee Stadium, there's so much history and nostalgia there. When you're driving around Northern California, it's like every exit, like Cupertino and Sand Hill Road, and as you're passing it, and you see the buildings on the side of the road, and you're like, oh, there's Joe DiMaggio. You're looking at those things. So if you're interested in technology and you're there, it's almost you can't miss it, and you get intoxicated by it. Even if you're on a side street, you see the marketing automation companies or whatever it is, and you can't help but get caught up in it. And it's just very different. Here, the companies are hidden. Like, you don't, it's kind of like when you go down to Miami, you see all these big houses, but in New York, there's more money in New York than anywhere, but it's all hidden.
True, except that, Meetup.com is a New York City company, and it lets people get together for offline events. The single largest category of meetups are tech-related meetups, and the single largest tech meetup is the New York Tech Meetup. So the single largest meetup, in-person meetup in the world on the Meetup platform is the New York Tech Meetup, which now has 36,000 members. There are 36,000 people who belong to New York Tech Meetup that meets once a month. The tickets, it's held in the NYU auditorium, which seats 800 people. The tickets sell out within 30 seconds of going online, because we were thinking of actually doing a thing in the Barclays Center, which is the only place that could fit the entire organization. So you're absolutely right, which is that the difference in zeitgeist is the Silicon Valley.
Well, the Yankees were terrible this year.
But
There's
you're right.
always other teams that win.
It's much harder to get noticed in New York.
Right. I mean, Silicon Valley, think about it, is a one-company town. Everybody in Silicon Valley is in tech. You go to Starbucks and you are looking at either your competitor or a future employer or whatever is here, right? On the other hand, in New York City is the capital of the world of finance, the capital of the world of advertising, the capital of the world of fashion and food and all these other 7 different industries over here. And in those, New York is the fastest growing tech center of the world. But what you're now seeing, and the reason that New York has had this extraordinary resurgence, or resurgence in the first place, not a resurgence, in the last 10 years, not only Michael Bloomberg being a great cheerleader for this, but because now, as technology gets applied to everything, it is applied to finance and fashion and advertising and marketing and food and all the things for which New York is the world capital. And that's why we are the capital of ad tech and fintech and everything else here.
the whole industry is a tool to build other things. So New York does have those other things and the knowledge base of those other things. We have time for one more, or
I forget the word that it's got dash. What do they say? It's got like the Valley's got like the kids say it's got pizzazz or something out there. And other than the pizzazz, it's just pizzazz. It's hype.
I think it's
Okay, we have to wrap up.
Swag. That's it. It's got swag.
Depends on your generation. All right, well, thank you, everybody, for coming. I hope this was worth the couple hours that you were here. And thank you to the panelists for taking your time.